Yes. And then I'll start answering some. Yeah.
Clearing on like chips and Fedwire and like the interaction between the two, because you mentioned like there's it clears on chips first and then Fedwire clears and like
Yeah.
just how that works.
Okay. Clearing chips versus Fedwire. So the first 4 lectures of the course are trying to introduce the balance sheet approach. Then we do the payment system for 4 lectures, and then we did market making for 4 lectures. So the payment system you'll remember that there was first a general lecture about the Fed as a clearinghouse, in which I talked about clearinghouses and netting of payments and so forth. And we talked about a clearinghouse, a private clearinghouse, as having member banks A, B, and C, D, and so forth, okay? And so that whenever a member of this clearinghouse makes a payment to another member during the day, okay, there's no actual payment, okay? It's just the clearinghouse is on the other side of all of those payments. So that if I'm a member of the clearinghouse and I want to pay Bank B, okay, the clearinghouse registers that as due from A and due to B, okay? So that if A makes a payment to B, that's what happens during the day, okay? Is that there's these entries in their own accounts on the balance sheet of the bank, and so forth for C and D and everyone else. Okay, at the end of the day, you know, A has both due froms and due tos, and since it's due from and due to for the clearinghouse, you can net that out. Okay, and so there'll be a net that's payable at the end of the day. Okay, and the same for B. And the same for C and D, okay, at the end of the day. That's what we call clearing on chips, okay, is where you net everything out. And the problem is that some of these accounts will be positive, some of them will be negative, some will be positive, some of them, and so the settlement's not done until you actually get the deficit people paying the surplus people. And they have to pay them not in stuff that's payable at the clearinghouse, but in the next higher order money, okay, which is reserves at the Fed, okay. So there will be now to settle at chips settles using Fedwire, okay, so that the banks that are deficits have to pay real money, you know, have to pay the settlement constraint, have to pay real money to the banks that are surplus, okay. So that's stage 1, okay. And then stage 2, I talked about the Fed funds market as a way if you're a deficit agent and someone's a surplus agent and you don't have any funds to pay them, okay, how do you settle? You borrow from the surplus agents. They lend you the funds that you use to pay them, okay, so that it gets off the balance sheet of the clearinghouse, okay. So Fed funds market is about, ultimately, at the end of the day, it's about deficit agents borrowing the reserves they need to settle. Reserves they need for settlement. And who do they borrow from? Okay. Ideally, they borrow from the surplus agents. Okay, so they're borrowing from, and this is a fundamental principle of banking. You see this everywhere. You know, you see this within the Eurozone, the Target 2 clearing, you know, where national central banks are borrowing from each other, or interdistrict clearing in the Federal Reserve System. And that means that if the Fed funds market, you can also use the Eurodollar market for this. You could use the repo market for this. Okay, any short-term money market will do. The point about Fed funds, though, is that if you cannot find a counterparty, ultimately the Fed will be your counterparty. that the Fed is willing to lend you money so that you can clear at the end of the day through the discount window. So this is backstopped by the discount window. So,
That's only if they can't get the money in the Fed funds market.
I'm sorry?
They'd only have to borrow at the discount window if they couldn't get it in the Fed funds.
Well, I would put it, that's correct, but I would put it a little bit differently than that. They will only want to borrow from the discount window if they can't do it from the Fed funds market, because the discount rate is typically 100 basis points above the Fed funds rate. So it's cheaper to go to the Fed fund market. So you're going to go to the Fed funds market first. and only if you can't do business there will you go to the discount window. That's one of the reasons that banks don't like to go to the discount window, because if you do, everyone knows you're having problems settling. Okay, so you're actually willing to pay often quite a bit more than the Fed funds target. And sometimes they even pay more than the discount rate, okay, just so that they're not visible. I mean, if you look at some of the trades, it's on the New York Fed's website. Sometimes banks are willing to pay more than the discount rate in order that they're not revealed to the Fed as somebody who needs a help. So you remember how I drew this, right? That there's the Fed here, okay, there's the surplus. I forget which one I put on the left. One was the surplus and one was the deficit agent. Okay, and so the deficit agent is the one who has due to the clearinghouse, let's say, and the surplus has due from. Okay. And the way you're going to cancel that is by some transfer of reserves from the deficit agent to the surplus agent. And you can transfer those reserves easily by borrowing them from the surplus agent. So the surplus agent creates a creates a loan. So this loan replaces this, okay, and then you transfer the reserves that came from the loan away, and this loan replaces this, and then so that the reserves that are transferred are the reserves that you are getting back. Does that all add up right? Let me just make sure here. So there's due to, this is where it all starts here. Due from the clearinghouse, due to the clearinghouse. And if we had reserves, okay, we would just transfer reserves, and that would get rid of that. We would pay that off with that. Okay, and that would be eliminated, and we would have reserves here. That's right. Okay. Now, if we don't have any reserves, we have to borrow reserves. So we get a Fed funds loan, and that gives us reserves. That's where I was missing. Okay. When we do this, so these two things, when we borrow reserves, we get reserves, and then we transfer them. Okay. And here we have minus reserves when we're doing this loan. Okay. So now it all adds up. That's the way it works. Yes? LIBOR is the interest rate in the Eurodollar market, okay? And so I'm showing this all as Fed funds, but if these are foreign banks, they could use the Eurodollar, overnight Eurodollar market, okay, to do this same transfer. Because notice, these reserves are all kind of notional. You know, since you're borrowing reserves, these reserves don't necessarily need to exist, okay? You could just do it in the Eurodollar market, where these two people say to each other, instead of us both having positions against the clearinghouse, let's just have a bilateral position against each other, and and you could just do that in the Eurodollar market. Sure. So you wouldn't need any transfer of reserves. You can see it's sort of phony, this reserves, right? It's like you're transferring reserves that you borrowed, so it's a phony thing anyway. So you could just do it in the euro-dollar market, or if you didn't know each other, you could do it in the repo market if you had some other asset that you could use as collateral. The point is the economizing on reserves. The point is that the ultimate means of payment, okay, is the liability of the Fed, is these reserves. But so much of the clearing system, so you were asking about the relationship between this. The whole clearing system is set up to make sure that you almost never have to pay with reserves, okay? That it's basically a credit offsetting credit debit sort of system. If you really need to pay in reserves, there's something that is a problem. Okay, that's when the settlement constraint is really kind of binding, because nobody's willing to let you roll your payment off until tomorrow, and you really have to pay, and then you find out if you can pay or not. But the system, the elasticity part of the system, is the credit part, and the discipline is the settlement part, is the money part. So you see, this is why we start with payments, okay? Even though it seems sort of, I don't know, arcane and mechanical and so forth, I think there's a lot of intuitions about elasticity and discipline, about relationships between balance sheets and all of this. Learning about the payment system builds building blocks that keep you from getting tripped up later on in monetary economics. That you see that the payment system, it sort of has to be a credit system. And you get rid of the intuitions you have about payments that come from being a human being in the world paying cash, okay? And those intuitions are mostly wrong, okay, for understanding how the monetary system works, okay? They're okay for you, okay? They work fine for but if you try to build a monetary theory out of an analogy with individuals paying for retail, you're not gonna understand how the modern monetary system works. So the payment system is where we start. We understand it as a system in the beginning, and not do these little mundane little examples of barter and whatnot.